Welcome back to the channel. I'm Algabot, and today we're studying a MetaTrader 5 expert advisor called the Swing Boundary Engulfing Hedge. This is a pure price action strategy, which means it uses no traditional indicators at all. Instead, it reads the chart the way a discretionary trader would, by mapping out support and resistance from genuine swing pivots, and then watching for a 2-bar engulfing candle pattern at those levels. It also carries one signature mechanic, a pre-armed protective hedge. By the end of this video, you'll understand exactly how it finds setups, manages risk, and behaves when a level holds or fails. Let's start with the big picture of what this expert advisor is trying to do. The Swing Boundary Engulfing Hedge is built around a simple observation about how price behaves at important levels. When the market reaches a recent swing high or swing low, it tends to do one of two things. Either it rejects the level and snaps back into the range, or it fails the level, closing cleanly through it so that old support becomes new resistance and the move runs the other way. A trader who only fades these boundaries does well when the level rejects price, but can get caught badly when the level breaks. This strategy is designed to account for both outcomes at once. It enters a fade back toward the middle of the range when an engulfing candle confirms a rejection, and at the very same moment it parks a resting stop order just beyond the level. If the level holds, the fade works toward its target and the unused hedge is simply canceled. If the level instead fails, that resting stop fills automatically, and the new position rides the break in the other direction. The levels themselves come from fractal swing analysis. A swing high is a bar whose high is the highest within a set number of neighbors on each side, and a swing low is the mirror image. The distance between the most recent swing high and swing low defines the active range, and every other distance in the system, from the entry zone to the stops and targets, is measured as a fraction of that range. This means the strategy adapts automatically to any symbol or time frame without pip values baked into the code. It's framed for liquid foreign exchange majors or gold on the 15-minute through 1-hour charts, where swing rejections and false breaks tend to alternate. Remember, this is educational analysis only, and all trading carries the risk of loss. Now let's walk through the exact logic, step by step. On every freshly closed bar, and only while the account is completely flat, the strategy recomputes the most recent swing high as resistance and the most recent swing low as support. It then measures the range between them and derives a tolerance zone around each level as a fraction of that range. For a long setup, 3 conditions must all be true on the just closed candle. First, the candle's low must dip into the support zone, reaching at or below support plus the tolerance. Second, the candle must close back above support, showing that sellers were overwhelmed. And third, the candle must be a bullish engulfing pattern, a green bar whose body fully covers the prior red bar's body. When all 3 line up, the EA signals a buy at market and places its base take profit a reward fraction of the range back toward the middle. The short setup is the exact mirror. The candle's high must poke into the resistance zone, reaching at or above resistance minus the tolerance. The candle must close back below resistance. And it must be a bearish engulfing, a red bar whose body covers the prior green bar's body. When those conditions hold, the EA signals a sell, with its take profit a reward fraction of the range back toward the middle. Now for the risk side, which is where this strategy is distinctive. At the same instant the base position opens, the EA parks one opposite stop order beyond the faded level. For a long, that's a sell stop placed below support. For a short, it's a buy stop placed above resistance. The base stop loss is deliberately set beyond that hedge level. So if the level truly fails, the hedge fills first, and the 2 positions coexist as a genuine locked hedge. Each leg then carries its own structural stop and target. The hedge has a take profit further along the break and a stop that cuts it if price reclaims the far side of the level, meaning the break was false. Finally, the housekeeping rule. If the base position resolves while the hedge never filled, the resting hedge is canceled and the system rearms on the next swing setup. There's no basket logic and no money management overlay, just clean per leg structure. Let's read through the MQL5 on screen as if we were sitting in MetaTrader. At the top are the input parameters. SwingStrength sets how many neighboring bars define a pivot. ZoneFrac controls how close the candle's wick must reach the level. HedgeFrac sets how far beyond the level the resting hedge stop sits. Reward frac defines the base take-profit distance back toward the middle of the range. And we also have lots for the volume per leg and a magic number to tag the orders. Just below, the strategy computes the two engulfing patterns purely from open and close prices, with no indicator anywhere. A bullish engulfing is a green candle whose body fully covers the prior red candle, and a bearish engulfing is the mirror. Now look at the long block. The EA checks three booleans together. The candle's low touched the support zone, the close came back above support, and the bar is a bullish engulfing. When all three are true, it calculates the base take profit as support plus the reward fraction of the range, then calls trade.buy with the normalized stop loss and take profit, and afterwards parks a sell stop under support as the hedge. The short block is the exact opposite. It checks that the high touched the resistance zone, the close came back below resistance, and the bar is a bearish engulfing. The take profit is resistance minus the reward fraction of the range, and trade.sell opens the position before a buy stop is parked above resistance. Both sides are clean structural mirrors. Let's bring this to life on the chart, candle by candle. The first thing to notice is the two dashed horizontal lines. The lower green line at 1.0840 is support, drawn from the most recent swing low. The upper red line at 1.0900 is resistance, drawn from the most recent swing high. The space between them is the active range, and every distance the strategy uses is measured as a fraction of it. Watch the opening candles. Price is drifting lower from the middle of the range, with the first bar slipping, then the second pushing down further. The third candle in this decline is a red bar that closes near support, setting up the pattern. This red bar becomes the prior candle that the next bar must engulf. Now look at the fourth candle, the one marked by entry. Its low dips down into the support zone, actually wicking below the green line, which satisfies the condition that the candle touched support. But then it closes back above support as a strong green bar, and critically, its body completely covers the prior red bar's body. That's a bullish engulfing rejection that held support. All three long conditions are met, so the strategy signals a buy here at around 1.0863. At the same moment, a sell stop is quietly parked below support as the protective hedge. From there, follow the next two candles upward. Price pushes off support. The fifth candle carries higher, and we reach the take profit marker at roughly 1.0876. Notice where that target sits, a reward fraction of the range back toward the middle, exactly as the code defined it. The level held, the fade worked toward its goal, and because the hedge never filled, it is simply canceled and the system goes flat again. Now the market keeps climbing toward the upper boundary. Candles 6 and 7 press up against resistance, with the seventh bar a green candle closing just under the red line. This green bar is now the prior candle for our next pattern. Then comes the eighth candle, marked sell entry. Its high pokes up into the resistance zone, even spiking above the red line, satisfying the touched resistance condition. But it closes back below resistance as a red bar whose body fully covers the prior green bar. That is a bearish engulfing rejection that held resistance. The short conditions are all satisfied, so the strategy signals a sell at around 1.0882, and this time a buy stop is parked above resistance as the hedge. Follow the final candles down. Price rolls over off resistance. The 9th and 10th bars step lower, and we arrive at the second take profit marker near 1.0864. Again, a reward fraction of the range back toward the middle. The level rejected price. The short fade reached its target, and the unused hedge is canceled once more. So across this sequence, you've seen both mirror trades, a long off support and a short off resistance, each confirmed by an engulfing candle and each protected by a resting hedge in case the level had failed instead. This is an illustration of the logic for educational purposes, not a prediction of results. So that's the swing boundary engulfing hedge. We covered how it builds support and resistance from fractal swing pivots, how it uses a 2-bar engulfing candle to confirm a rejection at those levels, and how it pairs every fade with a resting hedge stop that fills only if the level fails. We also read the core MQL5 for both the long and short sides and walk through a full chart example. Remember, Everything here is educational content only and not financial advice. Trading involves real risk, and losses can and do occur. If you found this analysis helpful, please like the video, leave a comment with strategies you'd like me to break down next, and subscribe for more MetaTrader 5 walkthroughs. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.